Welcome to the Byte-Size Brief. Today we are putting Palantir, that's PLTR, completely under the microscope. Let's get right into it because the setup here for you, the listener, is just wild.
Yeah, I mean, we are looking at an environment right now that completely defies basic market logic.
Oh, absolutely.
Yeah.
Because you are watching a company post what its own CEO is calling the absolute best financial quarter in a decade.
Right.
I mean, the revenue growth is explosive, the margins are widening, and they are locking in these massive, sticky multi-year government contracts. So as an investor, you naturally assume the stock is just, going on a tear.
You think so, yeah.
You pull up the chart expecting this massive green spike, and instead, bam, you see a 31% crash.
It's brutal. It completely shatters that fundamental assumption most of us have that good numbers immediately translate to a higher share price.
Exactly. PLTR recently hit a 52-week high of $207.52. But since hitting that peak, it has tumbled, hovering right around the $143 to $146 range. And yet simultaneously, CEO Alex Karp is out there doing victory laps.
So the mission for our deep dive today is to separate the underlying machinery of the business from, well, the manic psychology of the stock market.
Right. We need to cut through all of it.
Exactly. We're going to push past the extreme hype you see on retail trading forums, look past the intense fear gripping the broader tech sector, and examine the hard mechanisms driving PLPR right now in early 2026.
So let's start with that broader market panic, because to understand why a stock drops 31% after a blockbuster quarter, you really can't just look at the company in a vacuum.
No, you have to contextualize what happened between January and February of this year. We went through what analysts are dramatically calling the SaaSpocalypse.
The SaaSpocalypse,
Yeah.
which is, a very dramatic name.
It is, but the financial carnage was very real. I mean, in roughly 30 days, the global software market lost almost $2 trillion in total value.
No, $2 trillion.
Yeah. And the catalyst wasn't rising interest rates or inflation, which is what we usually see. It was artificial intelligence. Specifically, AI agents suddenly crossing this capability threshold where they aren't just drafting emails anymore, they're doing the actual work of entire human teams.
Okay, hold on. Let me try to break this down for the everyday investor. So basically, if I'm running, say, a mid-sized logistics company, and I have a team of 50 people handling supply chain routing,
Okay, tracking with you.
I might traditionally buy 50 software licenses from a company like Salesforce or Atlassian, right? I'm paying a monthly fee per human.
Exactly, the per-seat model.
But suddenly, 10 AI agents can do the routing work of 40 of my staff. So I lay off 40 people, and I instantly cancel 40 software licenses.
Right.
That per-seat revenue model just evaporates overnight.
You've isolated the exact mechanism of the crash right there. Traditional software as a service, or SaaS, is fundamentally tethered to human headcount. Yeah. The market realized almost instantly that as AI adoption scales up, human headcount in front of computer screens scales down. Between mid-January and mid-February, Atlassian dropped 35%. Salesforce dropped 28%.
Just a total bloodbath.
It really was. Investors were liquidating anything with the word software in its prospectus and dumping that capital straight into the hyperscalers.
Right, and for you listening, when we say hyperscalers, we are talking about the massive cloud providers.
Yeah.
Amazon Web Services, Microsoft Azure, Google Cloud, the companies physically hoarding the GPUs and building the data centers.
Exactly. The market decided that infrastructure was safe, but software was dead. And ironically, Palantir's CEO, Alex Karp, publicly predicted this exact collapse.
Wait, really?
Yeah, he went on record declaring that AI had made many traditional SaaS companies, quote, no longer necessary.
Okay, but hold on. That highlights a massive contradiction here.
Ah.
If Karp literally warned everyone this was coming, why did PLTR's stock price tank 25%? Right alongside the rest of them?
That's the million-dollar question.
Is the market just blindly lumping them in with the losers during the panic selling? Because if traditional SaaS is just like a digital notepad that AI can easily replace, PLTR feels fundamentally different. Isn't it more like the actual nervous system, the core data infrastructure, that the AI actually needs to function?
That nervous system analogy is incredibly accurate. And it's rooted in a technology they call their ontology layer.
The ontology layer.
Right. So when an enterprise deploys Palantir's platforms, like Foundry or their artificial intelligence platform known as AIP, they aren't just getting a dashboard. The ontology layer goes into the deepest, messiest parts of a company's data architecture and physically maps it out.
I want to push on that mechanism a bit because mapping data sounds like generic tech jargon.
Sure.
If I'm a massive global airline, how does this ontology actually work in practice?
Let's use that airline example. An airline's data is heavily siloed. You have live weather telemetry coming in via modern APIs. You have crew scheduling trapped in some 30-year-old archaic mainframe.
Right.
You have maintenance logs written as unstructured text in PDF files.
Oh.
And you have real-time engine sensor data. Traditionally, none of these systems can speak to each other.
They're completely isolated.
Exactly. The ontology ingests all of it. The PDFs, the mainframe data, the live sensors, and it creates a unified digital twin of the entire airline.
So when a massive blizzard hits Chicago and the airline needs to figure out how to reroute planes, an AI agent isn't just randomly hallucinating a schedule.
No, not at all.
It is querying the Palantir ontology. It reads the FAA rest rule PDFs, cross-references it with the live location of the pilots, checks the engine maintenance status, and outputs a viable, safe rerouting plan in seconds.
Precisely. PLTR provides the bedrock of truth.
Oh.
If you just let an AI loose in an enterprise without that ontology layer, it will hallucinate, make illegal decisions, or literally crash the system.
Oh, wow. So they're the guardrails.
Yes. Palantir acts as a system of record that governs the AI. That fundamental architectural difference is why their underlying business didn't break during the SaaSpocalypse, even if algorithms and panicked day traders dragged their stock price down temporarily.
They don't charge per human seat.
Exactly. They charge for the complexity of the nervous system they build.
Okay, so compared to last quarter, what actually moved the needle here for PLTR investors? Because if they survive the SaaS crash fundamentally, we need to look at the actual hard numbers from Q4 2025 to prove that resilience.
And the Q4 numbers are just an avalanche of validation. Overall, top-line revenue hit $1.41 billion.
Wow.
That is a staggering 70% increase year over year. But more importantly for their financial health, their adjusted operating income was $798 million. That implies an operating margin of 57%.
57%. Let's quickly define adjusted operating income for the listeners, because tech companies love to throw around non-GAAP metrics.
They certainly do.
Non-GAAP stands for generally accepted accounting principles. But when a company says adjusted or non-GAAP, they're usually stripping out massive expenses like stock-based compensation.
Which is huge in tech.
Right. Historically, tech companies issue millions of shares to pay their engineers instead of cash, which dilutes the value of the stock for regular investors like you and me.
And that has been a massive historical critique of PLTR. For years, they survived by diluting shareholders to pay their talent.
Yeah, people hated that.
But the inflection point in this latest quarter is that even when you factor in those GAAP requirements, they are producing massive amounts of actual unadjusted free cash flow.
That's a big shift.
It is, but to really see the momentum, we have to look at the quarter-over-quarter numbers.
Yeah, year over year can definitely mask recent slowdowns. Are they actually accelerating right now?
They are accelerating specifically where it counts. U.S. commercial revenue, meaning private American businesses adopting their AI platform, grew an explosive 28% compared to just the previous quarter.
Wait, 28% in one quarter? Not last year.
Not last year. Last quarter. U.S. government revenue grew 17% quarter over quarter. In Q4 alone, they closed 180 distinct deals worth over $1 million each.
That is massive.
It pushed their total remaining deal value, which is essentially their guaranteed backlog of future work, up to $4.4 billion.
Okay, I hear those U.S. numbers, but I am spotting a major red flag in the geographic breakdown.
Okay, what do you see?
Well, the U.S. commercial market is up triple digits year over year, which is phenomenal. But international commercial revenue only grew 2% for the entirety of 2025.
Yeah, that's true.
2%. If the rest of the world isn't buying this software, how can we justify treating them like a global tech titan? Are they basically just a one-trick pony relying entirely on the American economy?
Look, it is arguably the single largest operational risk they face right now. The thesis for PLTR requires exponential global scaling, but Europe and other international markets present severe structural roadblocks.
Like what? Regulations.
Heavy regulations. You have stringent data privacy frameworks like the GDPR in Europe, which makes ingesting and mapping an entire corporation's data legally perilous.
Oh, I see.
You also have vastly different enterprise cultures that are inherently more skeptical of overarching centralized data integration.
So basically, if the U.S. economy hits a severe recession or American enterprise budget suddenly tighten, they don't have a European safety net.
Exactly.
That 2% international growth isn't going to save them. The U.S. is the entire engine of this company right now. And looking at the breakdown, an undeniable piece of that engine is the U.S. government, which still makes up 54% of their total revenue.
And the government sector is their oldest vertical, but the scope of it is evolving rapidly. It's being driven heavily by the geopolitical instability we've seen in early 2026, particularly the escalating conflicts involving Iran.
Let's talk about the defense side, because earlier this year, the Pentagon officially adopted Palantir's Maven AI system, turning it into what they call a program of record.
Right.
This isn't just back-office logistics anymore. What is Maven actually doing on the battlefield?
Maven fundamentally changes modern warfare by compressing what the military calls the sensor-to-shooter timeline.
Okay, how does that work?
Imagine a fleet of surveillance drones flying over a hostile theater. They're recording thousands of hours of high-definition video. Traditionally, a human analyst has to sit in a dark room, watch those screens, and try to manually spot a camouflaged missile launcher.
Which sounds exhausting.
It takes hours, sometimes days, and humans get fatigued.
And I imagine by the time the human actually finds the target, the missile launcher has already moved.
Exactly. Maven integrates AI directly into that workflow. Palantir's software ingests those live video feeds, cross-references them with satellite imagery and intercepted radar data, and the AI instantly highlights the camouflaged target on a map.
Wow.
It alerts the local commander and instantly calculates the exact coordinates for the artillery units. A process that took 12 hours now takes 12 seconds.
That is terrifying but incredibly effective.
It is. By making Maven an official program of record, the Pentagon effectively guaranteed that PLTR software is a permanent sticky fixture in U.S. tactical operations.
Okay, so that explains the defense side. But it's not just the military. I'm looking at reports that the IRS is now quietly piloting a Palantir tool called SNAP. And this is where things get controversial.
Yeah, the domestic application of their tech is fascinating. The U.S. government is currently grappling with a projected tax gap, which is the difference between taxes owed and taxes actually paid of roughly $696 billion.
$696 billion?
Yes. And historically, the IRS has utilized over 100 highly fragmented, severely outdated database systems to flag potential audits.
And I imagine wealthy individuals dodging taxes aren't doing it in a simple, easy-to-read spreadsheet.
They never do. Tax evasion at that level involves complex webs of shell companies, obscure gift tax returns, offshore crypto transactions, and padded disaster relief claims.
Right. It's a maze.
The IRS SNAP tool, which stands for System for Non-Filer and Audit Prioritization, sits on top of all those legacy systems. It maps the relationships between, say, a suspicious real estate transfer in Miami, an offshore wire transfer, and a federal disaster claim.
Oh, wow.
It highlights the exact pattern of fraud that a human auditor would never spot across disjointed databases.
I see the utility, but as a retail investor looking at consumer sentiment, this is terrifying. I mean, you go on Reddit or Twitter right now, and the comment sections about PLTR are just a war zone.
They are very polarized.
Half the people view them as these patriotic defenders of Western democracy, and the other half label them a dystopian, evil surveillance company helping the IRS target private citizens.
Right.
So as an everyday investor, if college engineering graduates refuse to work there, or if there's a massive public boycott, does this toxicity actually risk their future contracts or stock price?
It is a valid concern, particularly regarding talent acquisition. But impartially speaking, public sentiment rarely dictates the success of a B2B business-to-business enterprise, let alone a B2G business-to-government contractor.
I have to push back on that, though. We've seen employees at Google and Amazon stage walkouts over military contracts, literally forcing management to cancel lucrative deals. Why is Palantir immune to that pressure?
Because Palantir explicitly filters for talent that aligns with their mission. Alex Karp has famously told employees who disagree with their defense work to leave the company.
Oh, right. He just tells them to pack up.
Exactly. But more importantly, from a financial perspective, governments and large institutions prioritize capability over internet discourse. For instance, PLTR is currently sitting on a potential $10 billion framework agreement with the U.S. Army over the next decade.
$10 billion.
A contract of that magnitude entirely shields them from retail PR noise. The Pentagon is simply not going to abandon a mission-critical battlefield intelligence system because of negative sentiment on a social media forum.
Okay, so their client base is completely insulated from consumer boycotts. The business operations are fundamentally secure. They have an undeniable technological moat, and they are printing free cash flow.
That's the bull case, yes.
But if PR isn't the threat that takes this stock down, what is? because dropping 31% from its highs means the market is terrified of something.
The ultimate risk factor for you as an investor right now is the valuation. PLTR is priced for a reality that leaves absolutely zero margin for error.
Let's define expensive in this context.
Right.
What do the valuation multiples actually look like?
By almost every traditional financial metric, the stock is staggeringly expensive. PLTR is currently trading at 195 times trailing non-GAAP earnings.
Ouch.
And perhaps more concerning, it trades at roughly 78 times price to sales.
Hold on, let's break down price to sales for our listeners because 78 is just an absurd number.
It really is.
A price to sales ratio tells you how much investors are willing to pay for every single dollar of revenue a company generates. So if you buy a local coffee shop that does $100,000 a year in sales, and you pay a 78 times multiple, you are paying $7.8 million for that little shop.
Right.
You are essentially paying for decades of future coffee sales up front, just hoping they keep selling coffee.
That is a brilliant way to frame it. To justify trading at 78 times sales, PLTR has to sustain a compound annual revenue growth rate of over 35% for years into the future.
Which is incredibly hard to do.
It's more than 2,300% above the sector median for software companies. Because of this astronomical pricing, Wall Street price targets are completely fractured right now.
I bet.
You have bearish analysts targeting $70 a share and bullish analysts targeting $260 a share.
So basically, buying PLTR right now is like buying a house in a bidding war at triple its actual appraised value.
Yeah, that's a good analogy.
You are just betting that the neighborhood gentrifies so aggressively over the next 10 years that your overpayment eventually looks like a steal. Any slight miss, any slowdown in that 28% U.S. commercial growth we talked about, and those valuation multiples will compress violently.
Multiple compression is the real danger. Even if Palantir continues to grow its earnings by 20% next year, if the market decides that a multiple of 195 is too high and adjusts it down to a more standard 60 times earnings, the stock price will plummet.
Even though the underlying business is technically succeeding.
Exactly. And it isn't just the valuation that has retail investors sweating.
Right. What is going on with the insiders? Because if the stock is priced for absolute perfection, I want to see management holding on for dear life.
Well, that is the other major red flag currently suppressing the stock. There is significant insider selling happening right now. In March 2026, Peter Thiel, one of the original co-founders and a massive strategic force behind the company, dumped 2 million shares of PLTR.
2 million shares.
Yep. And around the same time, a keyboard director offloaded 16,000 shares.
I don't care how you spin that. If Peter Thiel is cashing out hundreds of millions of dollars right now, shouldn't regular investors be sprinting for the exits? Is the smart money leaving? If the architects of the building are quietly parachuting off the roof, why are we buying the penthouse at 195 times earnings?
Look, it is entirely rational to be spooked by heavy insider selling, especially at these valuations. But you have to weigh that insider profit-taking against the company's sheer financial resilience.
Okay, fair.
Yes, the stock price is precarious, but PLTR boasts a true fortress balance sheet.
How much cash do they actually have on hand to back that up?
They are sitting on $7.2 billion in cash equivalents, and short-term investments. But the most critical piece of data, they carry zero debt.
Zero debt in this interest rate environment.
Zero debt.
That is an incredible advantage. I mean, when capital is expensive, carrying no debt means you aren't bleeding cash just to service loans.
Exactly. It allows them to aggressively reinvest that $7 billion into their AI platforms like AIP, pushing their technological moat even further without ever needing to borrow money from banks or dilute current shareholders by issuing new stock.
So cash is great for the underlying business. But as we just discussed, cash on the balance sheet doesn't stop multiple compression if Wall Street decides the growth story is slowing down.
That is the tension every investor has to navigate right now. Palantir operates like a high-wire act. The company itself is walking the wire with a massive $7 billion safety net underneath its operations.
Right, they aren't going bankrupt anytime soon.
No, but stock price itself is incredibly vulnerable to gravity. It requires flawless execution to justify its premium.
So bringing all of this together for the listener, we started by looking at a paradox. A stock that plummeted 31% despite posting its best quarter in a decade.
And what the data reveals is a company operating in absolute extremes. On the operational side, Palantir has an undeniable technological moat.
Yeah, they survived the $2 trillion SaaSpocalypse because they aren't selling easily replaceable per-seat digital tools.
Right. They are selling the core data infrastructure, the ontology layer, that actually maps an enterprise's messy reality so AI can function safely without hallucinating.
And the numbers completely validate that narrative. They are seeing explosive, accelerating quarter-over-quarter U.S. revenue. They are locking in massive, deeply embedded government contracts with the Pentagon's Maven system and the IRS's SNAP program.
And they are structurally shielded from public relations nightmares because their B2B clients only care about raw capability.
Yet on the financial side, the cost of entry for a new investor is almost prohibitive. A valuation of 195 times trailing earnings leaves zero room for operational errors.
None. When you combine that nosebleed pricing with the stark reality of heavy insider selling from figures like Peter Thiel and a completely flat international growth rate of just 2%, it raises valid questions about PLTR's near-term ceiling.
It really is the definition of diagnostic muddy waters. The company's underlying operations have a flawless bill of health, but the stock's valuation is entirely built on speculative perfection.
Which leaves us with one final provocative thought to chew on regarding their core business model.
Let's hear it.
PLTR is currently making billions by being the crucial middleman organizing incredibly messy human data so that AI can understand it. But what happens when the AI models become so advanced, so incredibly capable, that they no longer need a structured ontology layer to make sense of the chaos?
Oh, wow.
What if the very AI revolution Palantir is powering eventually gets smart enough to build its own nervous system, rendering the ultimate data architect obsolete?
That is the existential question for every infrastructure company in the AI era. Are you building the foundation for the future, or are you just building the scaffolding that the AI will eventually tear down?
That is something to keep in mind the next time you look at that stock ticker. All right, listeners, what's your take on the future of PLTR? Are you bullish, bearish, or just sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.